Be patient. Don't lock your money up for too long, and be ready to go for these opportunities. And there's opportunities in debt. There are opportunities in equities globally. There are opportunities probably in the property market today. But there was none of these, or very few of these last year. I'm seeing more distressed ideas today than at any point, with a very possible exception of that first week in March 2020 and in early 2009. There's been no period in the last 20 years there's been so many interesting distressed ideas. And yet people come to Real Vision are all gloomy and they're all unhappy. And from an investor's point of view, this is a great market.
Welcome to Make or Break. My name is Nick Lawson. I'm the CEO of Ocean Wall. I'm delighted to be joined in the studio today by Lee Robinson. Lee has had a very famous career, most notably in his time at Trafalgar in the early 2000s, where he was involved in the housing trade. He set up Altana Wealth in 2011. Early in his career, we managed to work together at Deutsche Bank and before that, Bankers Trust. Lee ran merger arbitrage. Lee now has turned his attention to macro, but also to some other trades. And the intention of Make or Break is always to look at the investment opportunities. Now, Lee, welcome. We're in a very, very complex market, one that I don't think either you or I have seen before. We can obviously have the battle scars of 2008, of LTCM in 97, and the Asian crisis that's taken place subsequent. But here we are now in a situation where we are seeing the equity market off by 25%. We've had the demolition of corporate bonds this year. We've been sideways hit by an invasion, a war that no one had predicted, not even yourself, at the start of this year. How would one look to try and approach, before we talk about investment ideas, navigating this environment? What should be the tool set one should look to try and think about?
Yeah, that's a good question. I think we got to step back a little bit. And I think we get caught up a lot in trading and forgetting about investing. Okay, investing is a long time horizon. And although I speak to, and I was at a Real Vision event last week, and how gloomy people were, you know, in reality, if you'd sat down with me this time last year and said, Lee, you know, how would you invest your money or advise people invest your money for the next 5 to 10 years? I would be saying to you, you know what, there's not a lot of investments I could make October 21 that would make money in real terms, and maybe nominal, but not in real terms, maybe not in either, right? Equity markets are expensive, property is expensive. We were in the everything but other thing. Everything was the most expensive it's ever been in time, right? Caused by low rates, etc. So you fast forward to today and you say, wow, there's lots of things I can invest in today that will make money most likely make money in real terms over the next 5 to 10 years. You know, you can argue about what your favorite trades are, but clearly if you're buying, you know, FedEx, you know, at 10 times mid-cycle earnings this year, and you're paying 18 times last year, it's a lot more interesting,
yeah, sure.
right? You're getting the year 10 to year 30 earnings of that company for free. Do you think they're going to be around in 10 years' time? If you don't invest, but you know, clearly different entry point. If you're getting 0 in the bank or minus 50, and today you're getting 4%, you can get paid to wait for opportunities. And you know, the best investors sit in cash for long periods of time. Now, some people can't do that because they have a cost of living, they're retired, but a lot of people, they're earning, or they've got a big pot of money, they can wait and they can predatorily pick things off. And so what I was saying to people today is there's suddenly a lot of opportunities, and there's going to be more for the reasons I'll tell you about in a second, over the next 6 to 12 months. Be patient. Don't lock your money up for too long, and be ready to go for these opportunities. And there's opportunities in debt. There are opportunities in equities globally. There are opportunities probably in the property market today. But there was none of these, or very few of these last year. I'm seeing more distressed ideas today than at any point, with a very possible exception of that first week in March 2020 and in early 2009. There's been no period in the last 20 years there's been so many interesting distressed ideas. And yet people come to Real Vision are all gloomy and they're all unhappy. And from an investor's point of view, this is a great market.
I think that's a very valid point, but I also think when I look at maybe channels like Real Vision and look at it from an existential perspective, as in outside of the trade ideas, I think what's happened has been we've had a democratization of finance with the advent of sort of push buttons, mobile telephony trading. We've had the idea of an increased universe via Twitter and other platforms, where Reddit, where people can communicate ideas. And I think when one looks at the money that's been given to people during COVID, and the ability to take leverage on certain sites, these have been negatives. And so I think a lot of people have got locked into meme trades, as they're known. I think it's quite hard to then to divorce oneself from those trades and store up dry powder. Now, it feels there's very little dry powder. If you were sitting here as someone who was down 25 for the year, what advice would you be giving in that regard?
Again, down 25 with how much free powder? You're saying with no free powder?
Yeah, well, you've been fully invested.
You've clearly made a mistake, right?
Yeah.
You made a mistake. But Warren Buffett, you might have heard of this guy. He's not bad at this investment game.
He's
not bad.
I'll Google him afterwards.
And he says investing is the art of the patient taking money from the impatient.
Yes, that's right.
And, he averages in, but yet everything on Twitter and Reddit is buy the dip. Today, this minute. Every time you see a wealth advisor, be invested today. Even though you just walked in the door, it doesn't matter. Yeah. Yesterday. No one says, well, why don't you average in 10% a year over the next 10 years and averaging 20% in down years and 5% in up years, or whatever it might be. That's investing. And basics of investing are different from trading. Trading's very tough.
Correct.
Investing actually is relatively easy. If you're patient, you can make money as an investor.
Yeah, no, I think that's absolutely right. I think an earlier twist on that, Buffett saying, was the Rothschilds, buy on cannon, sell on trumpets, where you look to take advantage of that point of maximum pain. We are, though, in a world, regardless of what you say about investment opportunities, where we're seeing an element of sort of systemic risks that we may not have seen before with things like the shadow banking sector. And obviously, without going over it, because it's been a much travelled route already, the idea that the amount of leverage that sits outside the banking sector, and just to give you some numbers, 20 years ago, non-banks held 51 billion of financial assets, banks around 58, so they were relatively equal. We're now in a situation where non-banks have grown to a scale of $227 trillion, and banks are 180 trillion. So we now have a situation where the asset management firms, the pension funds, and the insurance companies are now sort of dwarfing. They're the behemoth of this industry. And when we see the intervention that took place after the mini budget, and we've seen it again recently, should we be not worried about something bigger, a systemic issue to the market that maybe would be bigger than we've been talking, as in having investment ideas?
Look, I've been on Real Vision before, and I think if you could be bothered to listen to my 2015 interview, the end game is pretty ugly. You just said numbers today, that shadow banking, but either one of those two on their own, that number is shocking, right? Banking 180 billion versus 58. 180 trillion versus 58. These are shocking numbers. So the problem we have is the system's so big, and QE doesn't have an exit, right? You don't have an exit from QE. You don't solve a debt problem with more debt. No. I mean, it goes around in circles. So at some point, there will be an existential crisis of debt. Now, 2008 was very close. We solved that by making the system bigger. The big problem is going to get bigger and bigger. And my concern, if someone says to me, what's your concern, is that every recession, like the current one, which I think is not a terrible recession at the moment. I think it's an okay recession. I think the problem is every recession we face in the next 30 years, because there's so much leverage and debt, could morph into a crisis, as we saw with we've seen the yen move, and the buying of the yen hasn't made a big difference. We've seen the gilt market. We're going to see other markets explode. We've seen the energy crisis with margin calls on energy companies. The system's got too big with too little capital. And what's happening in the world today, which people aren't talking enough about, they're talking about interest rates, which is wrong. They should talk about real interest rates. It annoys me. Yeah. Annoys the hell out of me, because Japan's got higher real interest rates than the US, yet the currency's gone down. Why? Because capital outflows. And you've got everyone who's had to margin their interest rates or their energy has got to put up more margin. Everyone who's had to margin their currency because the move's put more margin. The Russian money has been frozen. It will go down as one of the worst decisions in financial history, because everyone who's not allied to NATO is sat there going, oh my God, I'm going to take my money out of the Western banking system. So the Chinese are going to take all their money out of the Western banking system, and so is every other dictator out there in the world. So guess what happens? The Western banking system shrinks, and guess what happens? The dollar goes up because of the shortage of dollars. Yeah. And so we got this problem where the West has not woken up to the fact that it's shot itself in the foot with FATCA, it shot itself in the foot with heavy regulation, it shot itself in the foot with too much QE, and now it's got this crazy system freezing assets and using SWIFT is going to take so much capital out of the system. These markets can go a lot lower. And going back to one of my big bugbears is the corporate bond market has been shut for longer this year than it was shut in 08, 09. It's just reopened, which is good news. But it's been shut for 7 or 8 months. Why? The capital doesn't know where to price. It doesn't know what it's repricing. Dramatically repriced from under 4% last year in high yield, if that's really high yield, to just recently 10. What does that do to asset prices? Yeah. Either the equity market is right, at whatever it is at the moment, the S&P, or the bond market is wrong. But if the bond market stays where it is today, corporate bonds stay where they are today, the equity market is going so much lower. It's shocking. Now, the good news is you could actually put a portfolio together today with a decent amount of defensive corporate bonds. I mean, we've got a portfolio of 1 year corporate bonds with household names.
Let me guess, it's paying you 6.5.
6.5. 6.5. And if you put in slightly more exotic names like Carnival Cruises, which probably won't go bust in 1 year, you can get 10. There is, what's it, Tina? It's now Tara, right? There is a realistic alternative, right? You can pick up 8 to 10% in a blended portfolio. You get a 4 and a bit percent in 2-year treasuries. Now, that wasn't around for the last 10 years. And a lot of people are going, oh, I can fund all of my expenses without having to reach for crazy exotic stuff and crazy investments. I don't need to lock my money up anymore. This is a seismic change.
Yes.
So to me, capital is shrinking. People haven't understood that. They've completely misread that whole thing, and they're looking at rates and not looking at capital flows. And it's a big, big problem for the West.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
So let's on that. I just want to very quickly looking at the impact on Main Street from Wall Street. So you mentioned that issue with inflation and where we are with real rates at the moment. You and I both know rates are too low, but the further that Powell goes, the further that the Fed go, the more likely we are, or one is, to start seeing businesses crash. Households, we know lots of people, with very, very high leverage on fixed-year mortgages that have to be rolled off. You then have that refinancing cost, people lose their jobs. Then you have to start thinking about the Fed from a position of having to make dramatic cuts to fund its own debt. So do you factor in a point where this almost Robert Rauschenberg financial world that's being created, this tomato that's too big for itself, means you can't put through the monetary pain to get the result you want, and there has to be a Fed pivot?
Disagree. What people have pinned their hopes on is that rates can't go too high because the cost of debt for the governments. Okay, now that may well be factually correct, but the pathway is not necessarily the same. What do I mean by that? The US had 3-year debt on average rolling over. In the last period, they've rolled it out to 6 years. So the Fed has said, oh my God, if rates stay at 4 or 5% and we have to roll over in years 5, 6, we're screwed as a treasury. Treasury's screwed. Now, that does not mean you can't raise rates to 6%, 7, 8% for 1 year, 2 years to kill inflation so that you get the rates down for year 5, 6. And that's what the market missed last year. And that's what a lot of the Real Vision guys have missed, right? They have woken up in the last 3 months and realized they have to kill inflation quickly because they can't leave it high. Now, if you listen to what Powell said in August, he said, I am going to be the new Volcker, basically. Yes. I am going to be the new Volcker. But if you actually listen to what he said something very interesting. He said, we're not going to make the same mistake as Volcker. What did he mean by that? Volcker is remembered for killing inflation. At the second attempt, he increased rates, took his foot off the pedal, inflation came back, and then he had to really ramp it up. They know if they do that in year 4, the Treasury's bust, BTPs are gone, whatever. So they've taken the view we need to raise rates aggressively and then bring them down. So this pivot you're talking about, I don't think these guys are pivoting in February, March. I think they want to see inflation so far in the back of the car, right, in the rear mirror. They want to see 6 months of good data before they say, we're not finished. Because they get to March and they pause and they see some bad data, they're going to go again. He's telling you that. And I think the market is saying rates can't go. I agree rates can't stay high forever because all these governments go bust. But they can be very high for 1 or 2 years. and then come down. And people are hoping that doesn't happen, and you shouldn't invest on hope.
No.
You should invest on a plan B. And my plan A is things are all right on the night, of course, but my plan B is I think these guys are actually determined. And Powell knows he messed up, as did all the central banks, messed up on this transitory stuff. He was saying 15 months ago, I'm not even thinking about raising rates, right? I mean, that's how confident, cocky he was. If he messes this up in 23, his legacy's gone, right?
Yeah,
he's finished, right? So I think these people are serious. I think a lot of the people who come on a Real Vision are still, they'll pivot, they'll save the equity market. If you fell into a coma in February 2020 with rates at 2%, and I woke you up today and I told you rates for 4.5%, and the S&P was 2,300.
My hair would be on fire.
You would say the S&P is 2,300. I'd say, where do you think, Nick, the S&P is today? And you'd say, well, it's got to be lower than 2,300. Maybe it's 1,800, right? Yeah. Double rates, double cost of capital. Yeah. There's a long way potentially to go.
I think we've socialised the idea of a Fed put, and I think a lot of that has come down to the idea of flat rates and the point you make about the concept of risk. We've all moved up the risk curve to negate the issue of the fact that rates anywhere else it's so low. And I remember going to buy a house with my father in the early 90s and saying to my father, if I buy this house, it was a cheap flat in the Docklands, would I lose all my money? And he said yes, because property was seen as a risk asset. And I think there has been an investing generation that have lost what that actually means, that there isn't a put, there isn't that Fed support.
But Nick, equity markets outside of the US, if you look at them over the last 20 or 30 years, Nikkei, Eurostoxx, a lot of these markets are down. So the equity market hasn't been a winner. We have been. I say it all the time. Don't confuse a bull market with genius.
Sure. Absolutely right. And I think that now is a nice segue into the investment ideas. When we first worked together on a trade, it was a very, very complex restructuring of Britain's nuclear energy fleet. It was British Energy back in 2003-04. And it required a huge amount of work. And also, by the amount we went down the rabbit hole, we ended up oversizing our position because we became absolutely convicted. What's really piqued my interest in you, Lee, recently has been your assumptions and your views around Venezuela. Now Venezuela is an interesting country because it has more oil, gas, bauxite and gold than Canada, the US and Mexico put together. And yet because of 15 years of sanctions, the bonds have been almost trading. At one point, our trading had got, at the end of the year, they got a cents in the dollar. So I know at the start of the year, they were as low as Cuba. Lebanon, which has no assets, was 5 cents higher. How did we get to this point with Venezuela?
Venezuela is a very strange situation, to be fair. Most distressed sovereigns go through this classic cycle. We're not going to default. The bonds trade at 80. Market realizes. Then they default and they trade at 40, 35, 40. Sri Lanka's just done the same. Argentina, Venezuela. And Venezuela did the same. They all do the same in the default. And all these very smart hedge funds come in and start buying the paper somewhere between 30 and 40 cents and then agitate and go through a process and get 75, 80 cents back or something, double their money. And we've seen it in Greece, Ukraine, Iceland, we have different scenarios. So, Venezuela being a super rich country, the same thing happened. And all these hedge funds came in at 30, 35 cents. And then something new happened. The Trump regime said, we're going to put sanctions on all Americans who buy bonds in Venezuela. All dollar bonds. These are dollar bonds that are predominantly owned by US citizens and US pension funds and everything else originally. And they said, look, you can't touch them. And by the way, we might even force you to sell them. So suddenly there's this big panic. The only buyer is predominantly US hedge funds or people or Swiss private banks who have some touch to America. They're all gone as buyers. There's more sellers. And guess what? Usual, price goes down. So, Venezuela is weird in that it would probably be trading at 30 cents if there weren't trading sanctions on the bonds, if it was just sanctions on the country. But it's a gift to all non-Americans because anyone who's a non-American can buy them at sub 10 cents.
And so US accounts who make up the shareholder list, the bondholder list, are completely frozen out from the trade.
They can sell, but they can't add. Can't do anything about it. So every time you get bond redemptions in an emerging market bond fund, they've got to find a buyer for Brazil, Argentina, whatever it might be, Venezuela. So they go out, and there's probably only a handful of buyers out there, and all the buyers tend to be full because you're buying at such incredible levels. You're buying at option value. You're buying at something that has non-zero end value because it's a sovereign. You know, Cuba's still trading, as you said, 3 or 4 cents 40 years later. So you're buying it at the moment, 7, 8 cents. Worst case, you sell at 4. The bonds have now got 60 points nearly of accrued in some cases. So you've got 160 you're playing for. You won't get all of it.
There'll be a haircut, naturally.
Probably be a haircut. But just, this is the thing with investing. I'm going to give an example. If you ask people 10 years ago, if a country with 500 billion of GDP and 150 billion of debt that was pumping 100 billion of oil a year, if you said to people 10 years ago, could this country ever default? You say, no, it's pretty unlikely. It's a slim chance, right? But it did. And its GDP went all the way down to 50 billion. And suddenly at 50 billion with 150, 200 billion of debt, you go, oh my God, can they ever repay? No. Well, actually, you know what? You rebuild the country, you build the oil rigs going, you can get back to 100 billion revenues. And suddenly you've got GDP of 200, 300, 400 billion, 5, 7, 10 years down the line. They could pay off the debt.
They could, yeah.
They could. They have the money. This is not Argentina or Lebanon.
Let's on that point then talk about sort of theatres of influence with the Russians. So I know that since 2006, the Russians have flown 3 bombers with nuclear capability over Venezuela. And there's always been this idea that the unofficially supported Maduro government have a sort of Marxist, but also Russian leaning. Is that a threat to the trade, or is there something going on with the US at the moment that changes?
There's no doubt that they have that leaning, and there's no doubt that that's where they stood 12 months ago. But the facts are the facts. The Biden regime and the Maduro regime,
administration,
regime and the Maduro administration, both have vested interests, and they've reached out. They've done prisoner swaps. Yes. They've allowed Eni and Repsol to start pumping. They've got Chevron. They've got talks going. And it was very interesting last week that there was a prisoner swap. And you go, well, what's interesting about that? Why on earth was that prisoner swap not done after the midterm elections? That could have been done in a month's time. Okay, it's not nice for the people to spend an extra month in prison, but they've been in prison for 3 or 4 years. They could have done that swap in a month's time and avoided any controversy ahead of the midterms. Why did they do it? Well, there's an urgency. Yeah. Because Maduro knows that in late 24, we might have a new Republican leadership, and he's back to square one. And Biden knows if the oil doesn't get pumping, he might not get reelected. So both sides have vested interest. I mean, don't forget, Saddam Hussein was an ally at one point, and then he was an enemy. You know, countries change, they have vested interests. Russia has interests, but Maduro's looking at it, and he's going, with the SWIFT system, maybe I can't rely on them anymore. And maybe they can't get the money over to me. So maybe he's playing both against each other. But I think we're missing the point. You know, Nick, at the end of the day, if you're paying 30 cents for something that might happen and get double back in 10 years or 1 year, it's a difficult trade decision. If you're at 7, 8 cents.
For sure. And this is dollar denominated.
Dollar, US law.
And US law. So, and so if one was to express that view, how would one do it?
You'd call me and invest in my fund. But yeah, that's basically
you're not the only, for the sake of, you're not the only fund. There are other funds out there, but it's a fund basis to do it.
Well, the problem is, going to detail, is that after 6 years in any US debt, there's a statute of limitations, which means that if you haven't claimed your debt within 6 years, the person that owes you money can quite rightly say, your time's up. And 6 years starts to kick in October 23. The default was October, first default was October 17. So you need to file your claims in the court. And if we get nothing happening by then, you know, you're going to have to spend a few $100,000.
So it's best to have a fund who can actually keep the claims alive.
You've either got to have a very large position and do it yourself, or what we've done is a group of people in a fund and do it ourselves and share that cost amongst, you know, my fund's 40 million, just to talk numbers. Yeah. So 300,000 is, you know, not terrible amount of money. But if you've got a $400,000 position, it's a lot of money. So you need to do it via vehicle. And there are hedge funds that hold it. There are other people that have got vehicles that do it. And so you need to be in that sort of place. And also the problem is, of course, it's very hard to actually, if you've got any US link in your bank, the bank won't deal with it.
It becomes verboten, you can't do it as well. Okay,
yeah.
Excellent. I want to move on to some other ideas as well. So an area close to both our hearts is merger arbitrage. We're now in a situation with the movement in cable, where and the contraction in multiples within UK stocks, where I imagine UK assets start beginning to look cheap. Are there names there within? And I also want to sort of contextualise this within your top-down macro view of keeping dry powder. Are there names that sit up in the UK at the moment?
I think it's difficult to speculate on names. I think there's a lot of very good business in the UK that are for sale. Always been for sale. It's always been a country with a lot of M&A. But you say there's a lot of dry powder, yes. And you say that multiple entries are down, yes. But cost of financing has gone through the roof, right? And to pick numbers, Lottomatic did a deal last month, 9.75%. They would have done that at 6.5% a year ago, right? So, funding for these deals is more expensive, and private equity to a degree is about cheap funding. So a lot of these deals still don't make sense.
Don't work.
Still don't work, because although you might bid for a company that's 5 times EBITDA, you've got to pay a premium, and the shareholders will just go no. I think what's more interesting is someone like myself who's been incredibly bullish the dollar for a long time, and been massively underweight euro and sterling. There'll come a point, particularly the euro, it's 90 something today. I'm bearish. I think you see an 8 handle. I think you see 85, 90, just to be clear on my view.
Yeah.
But we have a decent winter. Germany gets his act together. I can see 18 months down the line, the euro back at 115, right? So suddenly you're talking about even currencies which have been dull as hell from an investor point of view.
Attractive.
You start saying to yourself, I could buy the euro at between 85 and 95. I've got 10 cents of downside, 25% cents of upside. And similarly, sterling and other currencies suddenly become interesting. If I can buy corporate bonds at 8 to 12% with 1 year to go, how badly do I do? Well, not too badly, really, at the end of the day. So, we talked about Venezuela, but, there is a number of distressed assets out there. We talked briefly about Lebanon. I mean, everyone said to me, Lebanon, it won't trade below 10. I said, well, Venezuela's below 10. It will trade below 10. I picked some up at 6 last week. It's going to trade at 5. But, maybe that's dead money. Maybe it doesn't do anything. But your 5, maybe you sell at 4, but you may sell when a recovery at 25,
Yeah.
I want to talk about Ukraine, but Ukraine is now tottering around the 20-cent level. At some point, it will be interesting. Well, Ukraine is clearly a vital asset to both sides. It's clearly a strategic asset of very high importance. It's going to exist. It might be on the Russian side. It might be on the American side. There is a price where you'd want to own that debt, right? And that price isn't here, because I'd have no idea how long the war's going to last. But at some point, you're going to want to participate in the rebuilding of Ukraine, and it's going to be there. And at some point, Russia will have a new leader, not least because Putin's 70, he's not going to live forever. Things will change. And I think investing is about having some degree of perspective about things can change around the world. Who would have guessed? Someone said to me the other day, the first computer had 4 transistors on it, on a chip. And now 76 billion. I bet if you asked anybody, it's a blind-blowing number. The world changes, and the world's changing very, very rapidly. And you said earlier, we've been through a lot of things. I'm with you. I mean, COVID, financial crisis, oil trading at negative numbers. You and I could probably draw up a list, and there'll be 10 new things that we haven't thought of come up.
For sure. Which comes back down to the point of doing very, very detailed research, but always understanding the fundamentals of supply and demand, the old Druckenmiller idea of, where is capacity being taken out? What are the margins? Where will this business be in 3 years' time? And I want to sort of conclude this fascinating conversation that we've been having by touching on 2 other areas that I know you're interested in. We won't talk crypto because I know it gets heavy coverage. I want to talk about carbon, but I also want to start off, before we get on to carbon, about a thesis that we both share. And this is really just a touch on this because we've spoken about the Real Vision spoke about this before, uranium, because obviously we now have the fact that Putin has weaponized energy. Putin, we think, has obviously weaponized uranium with the transactions he's done in Uranium 1. The Rosatom enriches 40% of the world's uranium. Do you have a view there?
Well, I'm invested in uranium, and again, something I brought up in front of my first interview on Real Vision. I think it was a question of when. There was always a supply-demand dynamic. The nuclear reactor all the countries with nuclear reactors had to renew. I think there's a couple of things. I think one, the energy. I'm going to bring carbon in briefly and come back to uranium, because I think the 2 are linked. So we invest in carbon, and we got invested in carbon not because we're good guys. In fact, we're probably not the good guys. We got invested in carbon because we got involved in oil and gas. an oil and gas debt restructuring of all these gas services companies. And we realized they all had to clean up their act and they all had to buy carbon offsets or carbon credits. And we started looking at these things and going, oh my God, they're cheap. And there's a massive supply-demand imbalance. I mean, it's oil and gas today, but it's shipping tomorrow. It's, more and more people. And this year, the US announced that everybody has to report, and the SEC has to report their carbon exposure. And that is really important. I'll come back to that very quickly in a second. Carbon is first and foremost a tax, whether you like it or not. And the tax is there to either, some people would cynically say, to allow certain countries to finance themselves, but less cynically is to encourage transition to cleaner energy. Now, we follow this space closely and we're delighted that the world's going to cleaner energy, but it's going to take a long time, right? The technology that's being developed today will not be there probably for 10 or 15 years. So people are going to have to carbon offset their dirty concrete, their dirty oil, whatever. And part of that is we need stuff that works overnight when the wind and solar's not working. So we need better battery technology, and that will be key. But in the meantime, nuclear is the most obvious solution. And what's coming on board now is, I'm sure some of your people know, is, with SMR, with Rolls-Royce, there's these small modular reactors, still not coming on until 29, 32, but they're going to be huge, right? There's going to be lots of demand for uranium on top of what we've already got. We know the nuclear companies have got stockpile issues, and we know, as you said, certain countries are untouchable to buy the stuff from. So the nuclear thing is classic, and it's a classic one. All the people who are seeing their inventories go down, they've seen the price go down and say, I'll wait. And now they've gone up, it'll come back, and eventually they'll panic and buy it. So I think nuclear energy goes up a long way, even from here, but carbon goes up even more. Why? Because everyone's going to report their carbon, UK, Europe, US by next year. And everyone's going to say, well, carbon prices have got to go up because governments want them to go up to encourage less usage. And they cut the number of permits every year and they try and manage it up, right? And they think it's going to be gradual. But the carbon offset market, so when you fly on a plane and if you're a good corporate CEO and you offset your carbons, that's trading at 85, 90% discount to the carbon market, number one. And number two, everyone's going to sit there and go, oh, okay, every company I've got, all of us are short carbon. Yeah. And if my company can hedge the next 2 years carbon, how do I hedge the other 8 to 12 years of DCF? So every investment manager next year will say, well, what happens if carbon prices double? What happens to the margins on your company? What happens to the cost of capital for your company, right? And he's going to say, he won't be able to say, or she won't be able to say, I don't know. They'll have to say, I've done a calculation. My advisor says it's 4 to 8% loss or whatever it is. The next question you're going to be asked is, what are you doing about it?
Yes, yeah.
And anybody who does nothing about it will get sacked. So everyone's going to have to be forced to buy carbon. They're going to be forced to buy carbon regulatory. They're going to be forced to buy their investors. They're going to be forced by their conscience. I don't need to sell you on that. You're going to be forced to buy carbon. Myself, and this will come back to my black hat rather than my white hat, is that this thing's going to overshoot. Because if 0.1%, 0.2% of the investment industry has to buy carbon and the market's a couple of billion a year, the price is going to rocket. So it's my job to find investments in the space.
And how are you manifesting that? Is there any sort of uniformity in carbon bonds?
Oh, it's the Wild West. It's the total Wild West. It's a bit like the early days of credit markets. Things get rated by independent agencies, and then you've got to do all your work in the background. Who's the sponsor? What's the project? Is it reforestation? Which country is it in? But there are good actors who've got a track record, and there are people who are, shall we say, unproven. And there's some people you just don't want to be involved with. So it's a due diligence job. It's hard work, but it's a classic opportunity of fund management industry because it needs expertise and there's huge demand. And if you're buying less than $5 million, $10 million worth of this stuff as a corporate or a company or a sovereign or a local government, you're not going to hire a team and do it yourself. You're going to go externally to somewhere else. So again, I think the whole carbon market is a classic. And they said last year, it's part of the transition. COP26, they said we must have this.
Yes.
So what's priced at $10, you might have to sell at $5. But a bit like Venezuela, it's more likely to be 60 or 70. And it's a bit like uranium. Is uranium going to halve in value from here? Maybe.
It's the asymmetry of the risk reward.
Asymmetry. And I keep coming back to what's exciting about things, and I come back to even things like the euro. The range euro when it was at 115, could it go to 130? Could it go to what? I don't know. But suddenly the asymmetry is working in the investor's favor. And the investor's job is to go, wow, I'm buying stuff at the bottom end of ranges. And as long as they're not zero recovery, either frauds or broken, the odds are if you bought Chinese equities today on a 5-year view, I think you make money. I know it sounds silly, but it's just to come down a long way in the multiples. You're buying Alibaba and Tencent were what? They're up at the ceiling 3 years ago, right? You and I couldn't even think about looking at them. Now you think there must be value around it. There's a depressed property market. There must be value.
Yeah, of course, yeah.
And I think that's what's exciting for me as somebody who comes to work every day looking for opportunities. When I talk to Lee Robinson, I just talk to him a lot, is Lee, be patient the next 6 months because this is going to get probably cheaper before it gets.
For sure.
And so maybe you want to be buying a little bit now and averaging in, or you might want to be waiting for that. In the case of Venezuela, Lebanon, I'm not sure whether 1 cent makes any
There's a more timely nature. There's the midterms in November.
Well, not only that, even then, 1 cent, 2 cent makes no difference, right? If something like, to give you an example of FedEx, I'm not recommending to anyone, obviously, but something like FedEx at 150, I think you might see 120 and you might see 8 times mid-cycle. Suddenly it's a 2% position rather than 1% position, and at a much lower entry point. And I think that's the other thing. You're allocating more capital at lower prices. I come back to it. Being a trader is very tough. Timing, cycles. Being an investor, a lot of it's just patience and waiting for the opportunity to come to you.
And I think, look, in conclusion, the sort of evergreen nature of your fund is proven that. We all have to deal with the vicissitudes of the market. I think to do it on margin without proper research is folly. And I think it comes down to the laws of the idea of being utterly convicted in what you do, understanding the idea of the asymmetry, what's my max downside against that, and always staying on top of the trade.
I don't know if I agree with that. I think the vicissitudes of the market are not important to an unleveraged investor. The guys who own Mars have been through multiple cycles, haven't worried about the fact that if companies are throwing off cash flow and doing a good job, you should be grateful that your investments are cheaper because you can add to them from the dividend yield. I know it sounds silly.
Okay, no.
I really think
I'm trying to lock in
the investors.
The viewer will have been vulnerable to the vicissitudes of the market.
Correct.
And as a result, we'll probably look to try and find what the paradigm, the model is to take forward in their investing, which I'm saying is deep research, conviction, and asymmetry.
But I think if I was at the Blacklist event and I've been, I read the comments in Real Vision. Real Vision's got a very sophisticated investor base. It's got a lot of crypto traders, short-term people. It's got a lot of people in this short-term.
Absolutely.
And I think lots of those people will probably tell you they've had too much cash for the last 6 or 7 years, and I'd be included in that, kicking themselves, looking like idiots, and now they're sat there. The worst thing they do now is freeze and not put that money to work, because it's getting to a stage where if you've got money invested, I know it's difficult, you'll probably ride it out, be okay, but it's a whole swathe of people who should be saying, this is good news because I can put the money to work. And I think that's what I keep telling people. Put it in corporate bonds for a few months, put it in, but don't panic, but don't lock it up because you don't need to anymore. There's lots of liquid investments that are really quite attractive. Yeah.
Well, great. Well, thank you all very much for watching this show. And thank you very much.
Thank you, Nick.
To Lee. The Altana website address is
www.altanawealth.com.
And for Ocean Wall, we've written on Venezuela, we've written on uranium, and we share lots of views with Lee. It's www.oceanwall.com. Thank you very much.
Okay, let's get right into the key takeaways from that discussion. The first thing that jumped out to me was Nick's emphasis on just how much leverage there is in the global financial system today. The way that pension funds, asset management firms, and insurance companies invest and trade really has fundamentally changed. Shadow banking now dwarfs traditional banking in terms of assets under management, and all avenues of the financial system are seriously leveraged. That poses a grave risk of contagion, and something that every investor needs to be hedged against. The financial system has grown so big that quantitative easing doesn't have an exit. And as Lee says, you don't solve a debt crisis by taking on more debt. But the system is too big to fail, so the only answer to a recession becomes more QE. The main concern then is that every recession we face moving forward, even the ones that aren't all that bad, like maybe this one, will have the potential to morph into a crisis because there's such an overwhelming amount of debt in the system. To that point, Lee says that the West's decision to freeze Russian and Chinese assets is actually very risky to Western markets, because as dictators around the world remove their money from Western markets, liquidity shrinks and the dollar keeps pushing higher. And anyone familiar with the dollar milkshake theory knows that that is not good for global markets. Another key moment that stuck with me was Lee's thoughts on the Federal Reserve. He doesn't think that the Fed has to pivot, and he believes that Chair Powell is committed to killing inflation on the first attempt, rather than pausing interest rate hikes and allowing inflation to rear its ugly head again. That would mean raising rates well past the spring of 2023, where many investors are targeting as the Fed pivot point. As Lee puts it, don't confuse a bull market with genius. There will certainly be snapback rallies in the interim, but serious investors should be prepared for the reality of a sustained bear market. Finally, Nick and Lee wrapped up this fascinating conversation with a discussion on carbon and uranium. Both experts are invested in and excited about these alternative energy solutions. Lee points out that the regulatory requirements in oil and other industrial sectors are extremely bullish for the carbon trade. It will take decades for these industries to truly reduce their carbon footprint. So in the meantime, they need to buy carbon credits, driving up the price of carbon. Meanwhile, Lee says that nuclear is the most obvious short-term clean energy solution, and he believes that there will be lots of demand for nuclear energy in the coming decade. Still, he thinks that carbon will outperform nuclear simply because so much of the investment industry is going to have to buy carbon as a hedge as the price continues to go up. He emphasizes, though, that the carbon market is the wild, wild west right now. Every investor should do serious due diligence before deciding where to put your money. This was a terrific episode of Make or Break. We hope you'll tune in for more next week.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.